Imagine the sickening lurch in your stomach as you log into your bank account. Thousands of dollars have simply evaporated overnight. No unauthorized transactions, no hacking, just gone. A sum equivalent to a sizable chunk of your annual salary has vanished into thin air. It is a gut-wrenching thought. This kind of financial hit keeps you awake. It forces you to recalculate every aspect of your budget. It makes you question your long-term plans. Now, imagine something perhaps even more jarring. It involves a tangible asset, a major purchase. For many of us, this represents the second largest investment of our lives, right after our home. Imagine if the gleaming, brand new electric vehicle you painstakingly researched, eagerly ordered, and proudly drove home just last year had its market value plummet by a staggering 15 to 20% in a single day. Not over a year, not after a fender bender, but literally overnight. This is not some dystopian fever dream or a speculative nightmare. This is the stark, brutal reality facing countless electric vehicle owners in recent months. This is especially true for those nestled within the previously unassailable Tesla ecosystem. Their personal balance sheets have taken a direct hit. Their investments are devalued. Their confidence is rattled. This is all happening as the global automotive market barrels through an unprecedented and frankly terrifying transformation. It is a shift so profound, it is rewriting the very rules of how we perceive, purchase, and ultimately possess our vehicles. What is truly happening here is not just a blip on the economic radar. It is a cataclysmic event, a bloodbath, as some are calling it. It is reshaping the entire landscape of mobility. At the epicenter of this seismic shift is Tesla. Their recent aggressive, even predatory price cuts across their popular Model 3 and Model Y lines are not merely promotional discounts. These cuts are not designed to clear inventory or entice a few fence sitters. No, this is something far more strategic, far more ruthless. These cuts represent a bold, unyielding declaration of war from Elon Musk himself. It is a strategic maneuver aimed squarely at achieving nothing less than total domination of the global automotive market. Picture it, a company at the peak of its power, with a valuation eclipsing most traditional automakers combined. It suddenly decides to slash prices by unprecedented margins. We are talking dramatic reductions by thousands of dollars, sometimes up to $7,000 or even $10,000. These are on vehicles that were already considered premium offerings. These are not minor adjustments. These are tactical nuclear strikes in the ongoing automotive arms race. The shock waves from these decisions have reverberated across the industry. They have immediately, almost instantaneously, devalued existing assets on a massive scale. If you bought a new Tesla last year, your asset is now worth significantly less than you paid for it. This is through no fault of your own. It is simply because the price of a new one has dropped. It is an unsettling thought. This cruel trick of market dynamics puts immense, almost unbearable pressure on every single competitor trying to keep pace. What we are witnessing right before our very eyes is nothing short of a paradigm shift. For generations, a car has been viewed as a significant, albeit depreciating, asset. It was a symbol of freedom. It was a tool for livelihood. It was a repository of family memories. It was a substantial investment. While losing value over time, it generally did so at a predictable, manageable pace. It was a tangible item that held a certain residual worth. It often served as collateral or a meaningful trade-in down the line. It was something you expected to own for years, even decades. It retained a semblance of its original value. But those days, my friends, are rapidly fading into the rearview mirror. In this new era, cars are transforming at a breakneck speed. They are changing from those relatively stable, value-retaining assets into something entirely different. They are becoming fast-depreciating, consumable tech gadgets. Think of your smartphone. The moment you unbox that gleaming new device, its value begins to plummet. 6 months later, it is probably worth half what you paid for it. By the time the next model is released, it is practically ancient history in terms of market value. That is the trajectory our vehicles are now on. They are becoming less like a house and more like a laptop. More accurately, they are like a massive wheeled smartphone with an engine, or rather, a battery. This fundamental alteration is not just a matter of semantics. It is radically changing how we buy, how we own, and perhaps most crucially for many of us, how we invest in mobility. The emotional connection, the sense of long-term stability, the financial foresight that once guided our vehicle purchases are all being upended. No longer can we blindly rely on the assumption that our car will hold a predictable percentage of its value over 3 to 5 years. We are entering a volatile, unpredictable market. Yesterday's cutting edge can be today's discounted commodity, tomorrow's scrap metal in the eyes of the market. It is a wild west of depreciation. The consumer, the investor, and even the established automakers are all scrambling to find their footing in this new, unforgiving terrain. This is just the beginning. To truly grasp the magnitude of this transformation, we need to delve into the precise mechanisms at play. These strategic maneuvers are not just shifting market share. They are fundamentally re-engineering the very fabric of the automotive industry. It is a three-pronged attack. It is a pincer movement, executed by new titans of mobility, leaving the established guard reeling and struggling to adapt. First, let us turn our attention back to Tesla. Let us examine their audacious, some might say predatory, pricing and market domination strategy. Their recent price cuts are not random acts of generosity. They are highly calculated, surgical strikes designed to maximize impact and market disruption. Tesla is not just slashing prices. They are strategically positioning their vehicles, particularly the high-volume Model 3 and Model Y, just below critical psychological and regulatory thresholds. Consider the United States federal tax credit for electric vehicles. This can be a substantial sum, often $7,500. Tesla has shown remarkable adeptness at adjusting prices. Their vehicles either qualify for the full credit or come tantalizingly close. This makes the perceived out-the-door cost incredibly attractive. For instance, by pricing a Model Y just under the $55,000 SUV limit for the tax credit, or a Model 3 just under the $80,000 sedan limit, they essentially weaponize government incentives. They leverage a taxpayer-funded subsidy. This makes their product appear disproportionately good value compared to a competitor's vehicle. That competitor's vehicle might be priced only slightly higher. However, it then fails to qualify for that crucial financial boost. This is not accidental. It is a deliberate chess move. It ensures that their offerings do not just compete on raw price. They compete on the effective price the consumer ultimately pays, factoring in all available financial levers. But how can Tesla sustain such aggressive cuts? Cuts that clearly impact their gross margins, a key metric for profitability. This is where their pioneering manufacturing innovations come into sharp focus. The answer, in large part, lies in what Elon Musk famously dubbed the Gigapress. Imagine a car body. Historically, it has been an intricate puzzle of hundreds, sometimes thousands, of individual metal stampings and welds. Each part requires its own tooling. Each requires its own assembly process. Each requires its own inspection and its own point of failure. It is a complex, time-consuming, and expensive endeavor. The Gigapress fundamentally obliterates this complexity. Instead of hundreds of smaller components, the Gigapress casts massive sections of a vehicle's underbody as a single, enormous piece of aluminum. This colossal machine can weigh more than 400 tons and stands several stories high. Think of it like this. Instead of building a complex structure out of thousands of Lego bricks, they are essentially molding the entire foundation of the house as one giant, perfectly formed block. This single innovation dramatically reduces the number of parts required, Sometimes this is by up to 70% for a given section of the car. Fewer parts mean fewer welds, fewer labor hours, less assembly time, significantly less factory floor space. It also means improved structural rigidity and often lighter weight. This is not merely an incremental improvement. It marks a revolutionary leap in automotive manufacturing. It is akin to moving from handcrafting individual components to 3D printing entire subassemblies. These cost reductions are achieved through relentless engineering and manufacturing innovation. They are Tesla's secret weapon. They allow the company to absorb price cuts that would cripple traditional automakers. Legacy factories and supply chains are simply not equipped to achieve such efficiencies. This signals a clear and unambiguous intent. Tesla is willing to outcompete on cost. It is leveraging its production advantages to drive down prices. This strategy aims to challenge less efficient rivals. They simply cannot match Tesla's speed or cost structure. But the long-term play for Tesla extends far beyond merely selling hardware. This is true even if that hardware is increasingly cheap to produce. Elon Musk has always emphasized that the true prize lies in the software ecosystem and the data it generates. The aggressive price cuts are designed to accelerate market penetration. The more Teslas on the road, the larger the fleet available to feed their nascent software businesses. These include full self-driving, or FSD, and the eventual robotaxi network. Each vehicle sold is not just a car. It is a node in a vast connected network. It is constantly collecting data. It is improving the FSD system through real-world experience. Ultimately, it serves as a potential revenue stream through software subscriptions and autonomous ride-hailing services. The high-margin revenue, the true long-term profitability, is not in the one-time sale of the physical vehicle. It is in the ongoing recurring services and data monetization that come with a massive connected fleet. It is a classic platform strategy. Get as many users onto your platform as possible, even if it means sacrificing initial hardware margins. The real money is made in the ecosystem built on top. While Tesla attacks from the top, driving prices down on premium and mid-range segments, another formidable challenger is surging from below. This is creating a powerful pincer movement that is crushing the middle ground. This is the Chinese EV giant BYD, or Build Your Dreams. BYD is not merely competing, it is fundamentally disrupting the market with hyper-competitive, vertically integrated, and value-driven electric vehicles. BYD's strength lies in its unparalleled vertical integration. Unlike most automakers, who purchase components from a vast network of suppliers, BYD controls almost its entire supply chain. From the batteries that power its cars, to the semiconductors that manage their electronics, and even the electric motors themselves, BYD produces a significant portion of its own critical components. This is a game changer for cost efficiency. Imagine a company that mines the raw materials and processes them into battery cells. It then assembles those cells into battery packs. These packs are integrated directly into its own vehicles, alongside its own internally developed chips and motors. Every step of this process is optimized for cost and efficiency. It is free from the markups and logistical complexities of external suppliers. BYD's battery dominance largely stems from its focus on lithium iron phosphate, or LFP, battery technology. For years, the industry standard for high-performance EVs leaned towards nickel manganese cobalt, or NMC, or nickel cobalt aluminum, NCA, batteries. These were prized for their higher energy density, meaning more range per kilogram. However, LFP batteries, while slightly less energy dense, offer significant advantages. They are considerably cheaper to produce, they are more stable, they are safer, less prone to thermal runaway, they have a longer cycle life. BYD's Blade battery is a particularly innovative LFP design. It packages cells in a way that improves space utilization and structural integrity. By mastering LFP, BYD has unlocked the ability to produce long-range, high-quality EVs at price points. These are simply impossible for competitors relying on more expensive battery chemistries or external battery suppliers. They are demonstrating that cheap no longer means low quality or limited range in the EV world. This effectively challenges entrenched perceptions about Chinese manufacturing. It drives a consumer shift towards pure, unadulterated value. BYD's rapid global expansion is another critical element of this, quote, bloodbath. They are aggressively entering markets in Europe, Latin America, Southeast Asia. They are even eyeing a potential entry into North America. This is not just about selling cars. It is about setting a new baseline for what consumers expect in terms of EV price and performance. As BYD brings more affordable, long-range EVs to these markets, it forces the entire automotive industry to race to the bottom on price. They are the automotive equivalent of Xiaomi, the Chinese electronics giant. Xiaomi disrupted the global smartphone market by offering high-quality, feature-rich devices at a fraction of the price of established brands like Apple and Samsung. Xiaomi did not just compete, it redefined value, forcing every other player to either adapt or risk irrelevance. BYD is doing precisely the same for electric vehicles. It is creating immense downward pressure on pricing across all segments. Caught in the brutal crossfire of these two titans are the legacy automakers. These include the Fords, the GMs, the Stellantises, the VWs, and the Toyotas of the world. They are now ensnared in an agonizing sandwich squeeze. From above, they face the relentless price aggression of Tesla. This forces them to either match prices and sacrifice decades of brand-built profitability, or watch their market share erode at an alarming rate. From below, BYD's hyper-efficient, vertically integrated, value-driven approach is setting new, impossibly low-cost benchmarks. This makes it incredibly difficult for legacy players to compete without fundamentally restructuring their entire operations. This leaves legacy automakers with an excruciating choice. Do they slash prices, eroding the profit margins that have sustained their massive global enterprises? These margins have paid for their vast dealer networks. They have funded their immense research and development budgets for generations. Or do they hold the line on price? Do they hope their brand loyalty, dealer service, and established customer base will see them through, all while risking a rapid and irreversible loss of market share to their nimbler, cost-advantaged rivals? It is a lose-lose proposition for many of them. Their struggle is compounded by several deeply ingrained challenges. Firstly, they must manage the immense cost and complexity of transitioning from internal combustion engine, or ICE platforms, to new competitive EV lines. They have billions invested in existing ICE factories, tooling, and supply chains. These cannot simply be abandoned overnight. They must simultaneously develop cutting-edge EV technology. At the same time, they continue to produce and sell their profitable but declining ICE vehicles. This dual strategy is incredibly expensive. It stretches resources thin. Secondly, their production costs for EVs are often significantly higher than those of Tesla or BYD. Legacy automakers lack the Gigapress scale innovations of Tesla. They do not possess BYD's vertical integration. This means they rely on external suppliers for expensive components like batteries and chips. This incurs additional costs and markups at every stage. They also grapple with decades of entrenched operational complexities. These include unionized labor forces with established wage structures and benefits. They have vast legacy pension obligations. They have complex multi-tiered dealer networks that add significant costs to the distribution model. These factors contribute to a fundamentally higher cost structure. This makes it incredibly difficult to compete with the new efficiency benchmarks set by Tesla and BYD. Adding to this perfect storm is the broader macroeconomic context. While EV growth is undoubtedly strong, the global new car sales figures, particularly post-COVID rebound, are showing signs of overall stagnation or even contraction in some mature markets. This means that the fight for market share is not happening in an endlessly expanding pie. It is happening in a more constrained environment. This makes every percentage point of market share even more fiercely contested. The bloodbath is not just about who builds the best EV. It is about who can build it cheapest, sell it most effectively, and survive in an increasingly cutthroat landscape. The traditional rules of engagement have been utterly rewritten. The mechanisms we have just explored are not abstract economic theories. Tesla's predatory pricing backed by manufacturing breakthroughs. BYD's bottom-up disruption with unparalleled vertical integration. The agonizing squeeze on legacy automakers. Their combined force is generating seismic impacts. These will profoundly reshape the financial lives of consumers and the strategies of investors for years to come. The most immediate and, frankly, terrifying impact for consumers is what we can call the great asset value collapse. We are witnessing the rapid, unpredictable, and often sudden depreciation of vehicle assets. This is particularly true for used electric vehicles. In this new era, new car prices fluctuate wildly. They are aggressively driven downward by strategic maneuvers. The resale value of a recently purchased car can literally evaporate overnight. Imagine buying an electric vehicle, paying full price, then just months later seeing a brand new version of the exact same model offered for thousands, even tens of thousands of dollars less. The effect on your existing vehicle's value is devastating. Your asset, your investment, just took a massive, unrecoverable hit. This phenomenon is leading to a surge in what are ominously known as underwater loans, or even more vividly, zombie cars. An underwater loan occurs when the outstanding balance on a vehicle loan exceeds the vehicle's actual market value. If you paid $40,000 for an EV last year, and due to new price cuts, its resale value drops to $28,000, you are $12,000 underwater. Should you need to sell that car, you would still owe the bank $12,000 even after the sale. This debt provides no tangible asset in return. This is not just a personal financial headache for individual consumers. It poses a serious systemic risk to the entire automotive finance ecosystem. By extension, it threatens consumer credit markets. Banks and lending institutions that have underwritten these loans face potential losses. Consumers burdened with these debts may struggle to secure future credit. This creates a ripple effect across the economy. For generations, the traditional view of a car was that of a significant, relatively stable asset. It was second only to a home for many households. It was a tangible piece of wealth. It was something that held a predictable, albeit declining value over time. That era is definitively over. The car is now becoming a high depreciation information technology device. It is much like a smartphone whose value halves the moment you unbox it. We are entering a cycle where technological advancements, battery chemistry breakthroughs, and relentless price wars will render vehicles old, not after 10 years, but potentially after just 2 or 3 years. This fundamental shift requires a complete reevaluation of how we budget for, purchase, and think about automotive ownership. Hand in hand with the great asset value collapse is the accelerated demise of the internal combustion engine vehicle. As EV prices drop, the perceived value of ICE vehicles is plummeting even faster. Consumers are increasingly questioning the logic, both economic and environmental, of buying an expensive, fuel-intensive ICE car. This is especially true when a comparably priced or even cheaper electric vehicle offers significantly lower running costs. It provides superior acceleration, a quieter ride, and often more advanced technology. Why commit to higher fuel bills more frequent maintenance, and a technology that is rapidly becoming obsolete. An EV offers a more future-proof and often more affordable total cost of ownership. This shift is not just about environmental concerns or green initiatives. It is about pure, hard economics. The price elasticity of demand for ICE vehicles will increase dramatically. Every downward tick in EV pricing makes an ICE vehicle look less and less appealing by comparison. This will accelerate the decline of a market segment that still accounts for the majority of global sales. It will push legacy automakers even harder to transition, or risk being left behind with rapidly depreciating inventory and dwindling demand. For investors, this bloodbath is transforming the automotive sector into an incredibly complex yet potentially lucrative minefield. The era of simply investing in, quote, EV stocks or battery plays as a homogeneous, guaranteed growth sector is over. This price war demands a far more nuanced, analytical, and discerning investment strategy. Blindly buying into any company associated with EV or battery may now carry significant risk. Investors should beware of companies that cannot adapt swiftly and ruthlessly to cost pressures. Those clinging to outdated manufacturing processes, relying on expensive supply chains, or burdened by high fixed costs will struggle immensely to survive, let alone thrive. Instead, the focus must shift to players with demonstrably strong software-defined vehicle capabilities and significant data monetization potential. This is much like Tesla envisions with full self-driving and robotaxi. These companies can generate high-margin, recurring revenue streams. These are less susceptible to hardware price wars. Equally compelling are those with deep vertical integration and inherent cost advantages, exemplified by BYD. Companies that control critical parts of their supply chain, from raw materials to finished components, will be better positioned to weather price wars and maintain profitability. Opportunities also lie in companies enabling manufacturing process innovation. Such companies are developing advanced casting technology like the Gigapress, or innovative robotics that drastically reduce production costs. Furthermore, suppliers capable of rapidly adapting to or dominating lithium iron phosphate battery technology present significant growth potential. This technology is now critical for achieving mass market price points and cost efficiency. This crisis is not just destroying old value, it is creating new, more resilient forms of value, but only for the most agile and strategically positioned players. We stand at an inflection point. We are witnessing a brutal, strategic market reset. This is not a temporary blip, but a fundamental re-engineering of the entire automotive landscape. Tesla's aggressive price cuts, fueled by manufacturing innovation, are a declaration of war. They are designed to eliminate competitors and reshape consumer expectations. Meanwhile, BYD's rise from below, with its unparalleled vertical integration and mastery of cost-effective battery technology, is setting a new, impossibly low baseline for value. This Pincer movement is crushing legacy automakers caught in the middle. It is forcing them into an agonizing choice between profitability and market share. The most profound shift for consumers is that the car has fundamentally changed. No longer a relatively stable, value-retaining asset, it has transformed into a rapidly depreciating, high-tech consumable. It is akin to a smartphone or a laptop. Its value is now volatile, susceptible to sudden market shifts. Its shelf life in terms of cutting-edge technology is dramatically reduced. This new reality demands a complete overhaul of our perception of automotive ownership and investment. Survival and success in this new era hinge on three interconnected pillars. First, unparalleled software and data monetization capabilities that create high-margin, recurring revenue streams. Second, deep vertical integration for relentless cost control and supply chain resilience. Third, unwavering, relentless manufacturing innovation to continually drive down production expenses. Companies that master these three areas will not only survive, but thrive. They will become the new titans of mobility. For you, the informed consumer and investor, this era of unprecedented change presents significant challenges but also immense opportunities. Here is your three-step action guide to navigate this evolving landscape. First, immediately reevaluate your vehicle's residual value. Do not rely on past depreciation trends. They no longer apply. Utilize online valuation tools to get a realistic, up-to-date assessment of your current car's worth. This is especially important if it is an electric vehicle. Understand that the market is highly dynamic. Be prepared to adjust your personal asset portfolio if your car's value has eroded significantly. This is not about panic. It is about informed financial planning. Second, approach new car purchases with extreme caution. Do not be swayed solely by a low sticker price. While 2026 might be a year of unprecedented deals, the rapid pace of price cuts could mean your new car is worth significantly less within months of driving it off the lot. Instead of rushing in, wait 3 to 6 months. Observe how legacy automakers and BYD respond to the current price war. Look for signs of market stabilization or a clearer picture of long-term value propositions before making a major financial commitment. Lease options, which transfer depreciation risk to the leasing company, might become a more attractive alternative for some. Third, consider evaluating your investment portfolio. Shift your focus from broad, quote, EV sector investments. These are now highly diversified in terms of risk and reward. Prioritize companies demonstrating clear leadership in software-defined vehicle development. Focus on those with strong vertical integration and proven cost advantages. Also consider specialized suppliers who are excelling in lithium iron phosphate battery technology or advanced manufacturing process innovation. This crisis is weeding out the weak. Shrewd, targeted investments in resilient, innovative companies are absolutely critical for long-term growth. By understanding these seismic shifts, by acting with foresight and adaptability, you can protect your assets. You can make informed decisions. You can position yourself for new opportunities in this rapidly evolving automotive world. The road ahead is bumpy, but with the right map, you can navigate it successfully.